Boom. Welcome into our Friday Lunch and Learn workshop series. Today, we're going to be talking about making business taxes simple. And the point of today is not to give you an entire comprehensive overview of every piece of the tax code, but instead help you understand from a high level, what do you need to be looking out for? And what is the 1 minute version of taxes that you need to understand as a business owner so that you don't get hosed? Because I'll tell you, one of the biggest ways that business owners get hosed is by not understanding taxes and then waking up and having a big old tax bill that they didn't plan for. And so that's one of the main things that we do with people as they're working with us in CEO Finance Academy is helping them get a handle on what taxes actually look like for them and making sure that when they file taxes, they've already got the money sitting in their bank account ready to pay, or in many cases, they've just already paid it through quarterly. So let's dive in and look at how we're going to understand taxes today. I'm excited for this one. I've taught this multiple times. Oh, you know what? Actually, we're going to stop screen share. We're going to do it this way. Taught this multiple times in much longer format. So today we're going to shorten it up and just give you the most important stuff. Cool. And I mentioned earlier before we started recording that I'm a pretty visual learner. I can't understand this stuff if it's just all text. So hopefully you appreciate the Alex's simplified caveman drawings because that's the level that I can understand taxes at, not being a financial professional myself, rather being a business owner. So let's dive into this. First, this comes with a caveat. The following is meant for educational purposes only because I'm not a tax professional, okay? And so you should get professional advice before you make any important business decisions. What I find, though, is that business owners hire accountants and they think that they're just going to magically take care of all their tax problems and that as a business owner, they don't need to understand anything. That does not fly in business ownership. You need to understand what's going on. That's what today's about. Cool. So our goal is to help you feel confident about taxes as a business owner so that you can A, avoid tax problems, not end up in jail, and B, not overpaying by more than a penny than you absolutely and legally have to. Okay. So let's start with taxes here for a minute. I know that you're here to talk about business taxes, but we have to start with personal taxes, and we'll see why in just a minute. And as an individual, we're going to see this slide like 5 times. But here's the thing. You pay 3 different kinds of income tax as an individual. And I might even add the caveat as an employee. We've got federal income tax that we pay to the IRS. We've got, in some cases, state taxes, and we've got Social Security and Medicare taxes. Now, there are a couple others, but those are the big ones, okay? Those are the main ones when we think about taxes. So real quick, if you were to pull up a W-2 pay stub for yourself, and we were looking at this, and it's like, hey, here's the money that I made, and here's the taxes that I got taxed on. This would be federal taxes here at the top, right? Let's pull up ye old pencil. So we got our federal taxes right here. Next, we have our state taxes. In Utah, we pay like 5%. So there's our state withholdings and Social Security and Medicare. So there's our 3 different taxes represented on a W-2 pay stub. Now for federal taxes, we've all kind of heard about these different tax brackets. Most people don't actually understand how they work. So we're going to look at these for just a second. But there's a different tax bracket for if you're married filing jointly. There are different tax brackets for if you're a single filer. There's 4 primary tax brackets. We're going to look at the 2 that most people fall into. There's head of household and there's married filing separately as well. But each tax bracket, and these are the ones for 2023, each tax bracket has a specific tax rate associated with it and an amount of income that receives kind of that tax rate. So what does this actually mean functionally? Well, if you were filing as married filing jointly, and sorry, I got to move my face out of the way here. If you're filing married filing jointly, then your tax bracket would look like this. Let's imagine that you made $300,000 between you and your spouse. Okay, we're taking all income sources into account here. $300,000. Well, the first 10%, that you're taxed, that's going to happen on that first $0 to $22,000. So that portion is taxed at 10%. Then the next portion here from 22,000 to 89,000 in yellow, we get that taxed at 12%, right? So that little portion is taxed at 12. And then we stack on top of that, the portion that stacks at 22% between 190,000 and 89,000. So we can see that over here. And the upper part of it here, we're going to be taxed at 24%. So when you say I'm taxed in the 24% tax bracket, it does not mean all your income is taxed at 24%. It means that top little portion of it is taxed at 24%. So a lot of business owners / normal humans think, oh crap, if I bump up into that 24% tax bracket, now all of a sudden all my income gets taxed at that and I lose money overall by doing that. And that is not the case. We only get taxed on that little incremental part that is above, in this case, 190,000. Okay. That's how tax brackets work. Hopefully this is a little bit of an aha if you didn't understand this before. For most people, this gets really confusing, but if we understand this, then we can understand how we get taxed as a business owner much better. Cool. So then we got state taxes too. Every state has different taxes. This was back a couple of years ago. In Utah here, we're paying a flat. Now we're down to like 4.85%. Yeah, Utah. But if you're in Texas, you're in Florida, you're in Nevada, you're in Wyoming, South Dakota, or Washington, you might not have any state taxes at all. And instead, you're getting most of your taxation through like property taxes or when you're buying stuff. If you're in states like California, Massachusetts, Minnesota, for some reason decides to be crazy too, Oregon, you're paying a lot more in state taxes. And so our California clients, when we sit down and do tax planning, we have to plan to save more. We just do, because they're paying 8% more than someone like me in Utah. And so your state taxes do come into effect. Most people know what their state tax is, but we don't really think about like, oh yeah, living in some states is inherently more expensive from a tax standpoint. Okay. So then we got this Social Security and Medicare stuff. It's pretty straightforward. It's like 7.65% of your paycheck or your income up to the first 160,000. Okay. We're going to look at something really cool here in a little bit. All right. So there's the three kinds of taxes that we pay: federal income tax, state income tax, and Social Security and Medicare. Sweet. So with that understanding, let's talk about business taxes here for just a minute. So we've got this whole thing called self-employment tax. And the very first time I took on income outside of like working, a W-2 job, I remember I got 1099'd, and it was a sort of summer job where I was sitting there, I was tutoring some kids. I got paid as a 1099 contractor. I made all my money. I was so excited, and I went to pay taxes, and I owed so much money. I was like, gosh, this whole self-employment tax thing's a total racket. What's going on here? Well, self-employment tax applies if you are a single member LLC, or if you're an LLC taxed as a partnership. Basically, if you're not taxed as a C Corp or an S Corp, you're probably going to be paying self-employment tax. And this is an additional 15.3% of your income. And that's kind of broken down between Social Security and Medicare. And there's a little bit of it that they let you deduct from income taxes. It's half of it. But as a business owner, like, what is up with this? Well, if you were an employee, if you were a W-2 salaried employee, you are paying your share of Social Security and Medicare tax. It's happening every pay stub. It gets taken out no matter what. So remember back to our personal taxes here, we saw that Social Security and Medicare. And we can't adjust those up and down. It's not like we can say, yeah, don't withhold them like we can with federal withholdings, right? You might have seen this and been like, man, someone didn't pay very much in federal withholdings there. Yeah, it's because they were telling the government, I don't want to withhold for federal income taxes yet. But you can't choose that with Social Security and Medicare. It's mandatory. So there's your 7.65% of your paycheck. So there's your employee half. But what you probably don't know is that your employer is also paying their half of Social Security and Medicare if you're a W-2 employee. So there's the employee half, 7.65%, and your employer half of 7.65%. And together, we marry those, it's 15.3%. And now that you are both the business owner and the employee, if you are a simple LLC or an LLC taxed as a partnership, then you're paying both sides of that. And that's why it feels like it's so much more. It's really not all that much more. It's just that other 7.65% that you're used to not having to pay because your employer was, but now you're both employee and employer. So now we've got that, and you'll see that come out. If you have W-2 employees, you'll see that in your payroll taxes, right? There's our Social Security and Medicare. There's a couple other things that are unemployment unemployment insurance programs that we pay into as well as employers. We won't get deep into that today, but that's the deal with business finances on the payroll and on tax side. So now let's look at this from a business owner's perspective. I want you to imagine that you have a pair of finance pants. Okay, you're wearing these pants. By the way, this is an analogy that came from Brad Gibb, who runs a company called Cash Flow Tactics, that just made so much sense to me. It's like, ooh, I want to expand on this for taxes for you guys. So your finance pants. I want you to imagine that you've got these pants that you're wearing that have two pockets. On one side, one pocket is your business bank account. The other side is your personal bank account, but it's the same pair of pants, right? They're both your pants. So you are taxed. You personally are taxed when your business makes profit. So this is for our simple LLCs, for our partnerships. If you're a C Corp, it's a fair bit different. We're not going to get into C Corps today because 99% of you won't be. We will talk about S Corps in a minute, but you're taxed when the business makes profit. In other words, your personal taxes are completely affected by your business profit. So you're taxed based on the net annual profit. It's what your profit and loss statement would show at the very bottom for net income, right? Which is really just revenue minus expenses is our profit. Okay. So they're getting that directly from our P&L, profit and loss statement, which is why it's pretty important that that P&L is accurate. We did a whole workshop on making sure that your books are accurate so you don't overpay on taxes last week. If you want that workshop, you can comment better books below in the Zoom chat here, and Will can hook you up with the link for that. And if you're watching this on the replay, we'll probably put a link to it on the replay page too, because it's so important. Okay. So example real quick for federal taxes here. We've got revenue of 100 grand. Let's say we had expenses of 25 grand and profit of 75K. You personally would pay taxes on the profit of that 75,000. Cool. In addition to all your other income. Great. You're looking at this so far and you're like, Alex, this makes total sense. Cool. Let's look at it visually for a minute and break this down, because now it starts to get a little bit more complicated as we complicate our business structures. Right. So another way to look at it, here's your LLC. You had that 100K. Let's say in this case, we now have 100K of profit. Our business made even more. And we've got our financial pants on. This is our business bank account, right? And the profit is sitting there in the business bank account. Well, now let's imagine that we transfer all of that profit to our personal bank account, or not even all of it. Let's say half of it. Let's just say that we move 50,000 throughout the year over to our personal bank account. Now we've got 50 in our personal account, 50 in our business account, right? We still have that 100,000 of profit. But because of these financial pants, it doesn't matter which pocket the money is in. It doesn't matter where the cash is held, because it's still $100,000 of profit. And that's what I'm going to be taxed on. So your finance pants, we've got our business bank account, we got our personal bank account, and it doesn't matter because we're taxed when the business makes profit. That's really simple. When we just have an LLC, we're not taxed as an S Corp. Most people understand that, right? So as an individual, we're going to pay 3 kinds of income tax on that profit, right? Federal, state, and Social Security. And you're like, but it's business income. Yeah, but the government lets you set up this thing called an LLC, and they actually call it a pass-through entity, which means that the profit just passes through to you. And so it's still your profit. So you pay the tax on it personally. And this really screws people up. But when you pay taxes for income taxes and you feel like, oh, this is from my business, it's still you personally paying those taxes. It's not the business paying them. And so this gets a lot of accountants screwed up. When you make a personal tax payment out of the business and they just see, oh, that went to the IRS, then a lot of times I see bookkeepers categorizing your personal tax payment as a business expense. And that's a no-no. If the government were to catch that, it might flag things and say, ooh, audit risk, let's go in and audit it. And it's okay. Accountants have told me that you can pay your personal taxes through the business. They just need to know that that's a personal tax payment. So they count it as an owner's distribution or an owner's draw. All right. So now let's look at next level here. Now we talk about S Corp, and everyone talks about S Corp, but nobody understands what's actually going on. So let's take that same 100,000 of profit that you had. And instead, you're going to get paid in 2 different ways. This is the reason that you set up an S Corp, because you get paid in 2 different ways. One as an employee of the business and one as an owner of the business. You're now telling the government, I've got my LLC, but I want to be taxed as a corporation. And because of that, now I take some of my income through W-2 salary, and the rest of it, I'm going to take as if I were getting paid kind of like a stock dividend payout as an owner. Okay. So I'm getting paid for the work I do in the business as an employee, but I'm getting paid because I'm an owner of the business now. Just like if I own stock in it, I'm getting paid differently, and we get to be taxed differently. So watch how this works. Let's imagine that I've got an S Corp and I pay myself through W-2 salary. So I had my 100K of profit, and some of this is now passing through as W-2 salary, right? So I'm getting paid every single pay period, whether it's every 2 weeks or every month. And across the whole year, I get paid 50,000 in gross wages, right? So now you can notice, hey, that dollar's purple now. It's W-2 salary. 50,000 of my profit would still be sitting in the business. 50K is sitting in my personal account, but it's been paid differently, right? It's been paid as W-2 salary. And now we've got the 50K sitting there in the bank, right? 50K in the personal. But guess what? I'm still taxed as if, it's still all my profit. So let's look at how this change happens, right? I'm still paying my 3 kinds of income tax on that W-2 salary. It's still federal income taxes, state, and Social Security, just like we saw. But now here's the cool part. Get ready for this. I've got my S Corp set up. I'm paying myself W-2 salary, but now that the rest of that $50,000 passes through to me as a dividend. It's like I'm getting paid almost through stock. And when I get paid as an owner of the business, not just as an employee, I don't have to pay self-employment taxes on those dividends. So that 15.3% that I still have to pay through my W-2 salary, I don't have to pay any of that on the rest of the money that passes through to me. So whether I keep that money in the business as profit and it just sits there, or if I actually pay it to myself as a dividend, and I just do a bank transfer or I cut myself a check, that 50,000 now, I still pay income taxes on it. I still pay state income taxes as well, but I don't pay Social Security and Medicare. And so I save effectively close to 20% of your tax bill just goes out the door. And so if you're not yet an S Corp, you got to talk to your accountant, and it's somewhere around $50,000 of profit a year where this starts to make sense. So 50K plus per year of profit. If you're significantly above that, if you're at like 100K plus and you haven't made the switch to an S Corp, really grill your accountant on this, because you're almost definitely losing money in taxes. And so this is really important. Now, notice that whether that 50,000 is in my pocket or in the business, it doesn't matter. I'm still taxed on it, right? I'm still taxed on it because it's still profit. So here's, even if I say, well, I only paid myself 25,000 of dividends, doesn't matter. That 25,000 of profit that's sitting in there, you still pay on it because it's the same pair of financial pants. I should have my other 25K right here in the business account, right? Same financial pants, doesn't matter. I'm paying taxes on it. So whether it's in the business account or whether it's in the personal account, it is the same pair of financial pants. And I am taxed when the business makes profit. Does that make sense? Will you just put in the comments, makes sense, if that makes sense? And do you understand S Corp taxes just a little bit better than you did before? Because now we're going to look at how much do I pay and how do I save? Sweet. We got lots of people saying it makes sense. Beautiful. So remember that we're not paying taxes, or at least self-employment taxes, on the owner dividends. In other words, the profit as an S Corp. So if I run an S Corp and I want to know what my dividends are or what's passing through to me, I just look at my profit and loss statement and I see what is my net income. And that profit passes through to me, whether I actually pay it out to myself or not. All right. So some people say, well, Alex, I should always try to get my profits to zero so I don't pay any taxes, right? Very wrong. Now, there's lots of ways to do this, but you want you want to have as much profit as possible and then deal with taxes with the right strategies, because profit equals money in your pocket. And if we just go for break even as a business owner, first of all, it's just stupid, because it means that you're not going to be able to pay yourself, right? Now you might say, well, Alex, I just pass all my personal expenses through to the business. And so that way, like I'm still getting paid, but it doesn't show anything. Well, there's 2 problems with that. One is you actually want to keep money. The point is not to stop paying taxes. The point is to have profit. But someday you might be able to want to like buy a house or get credit. I just went through this over the last 2.5 years. We built a house, and getting a construction loan as an entrepreneur is like the most grilling experience financially. And guess what? If I just told them, you know what, I make tons of money, but I just put all my personal expenses through the business and I don't have any profit, they would say, that's wonderful. No profit, no house. And so someday, if you want to be able to get a loan ever from any bank, you want to show profit. And you have to show not only profit, but you have to show that you are paying yourself that profit. No profit, no house, no good, completely. So how much do we save for taxes then? Well, simple number, save 30% of your profit. Cool. For some business owners who are making, we'll just call it high income earners, and this is as a household. And I put that benchmark somewhere around, if you're above 250 to 300,000 as a household, you might need to bump that up to more like 35%. That's usually a max though. 35%. I don't think I've ever had to have a client go over 35%. Sometimes we can get away with 25% of profit savings if we're a little bit lower on the profit side of things, but 30% is a great benchmark. So we're going to look at your P&L statement every month, and you're going to say, all right, what is my net income? And I'm just going to multiply that by 30% times 0.3. And then I'm going to put that straight into a tax account. And I'm going to have a separate bank account that is not my savings account, that is not my checking account. It's just tax savings. And I put that money aside every month. Some business owners have a lot of volatility in their finances. So it's like 1 month I'm plus 50,000, 1 month I'm minus 40,000. Maybe we save every quarter for it then. Cool. Based on like the quarterly profits. So quick example, if you got 100,000 of profit in a year, you should have saved 30,000 bucks, right? So now there's this question though of, oh, you brought up this whole quarterly thing, and aren't there quarterly taxes? What are they, and how am I supposed to deal with them? Quarterly taxes are really just the government's attempt to get regular cash flow. Just like in your business, you want to get paid all the time. You don't want someone who sits there and owes you $100,000 for an entire year. The government doesn't like that either, right? They're pulling their taxes out of an employee's paycheck every single pay period because they want cash flow. But they can't do that. They can't just reach into your account and yoink out the money that you owe for taxes as a business owner. So instead they say, we would like you to pay quarterly. And the way it works is they have these specific due dates, right? For when quarterly estimates are due. They make very little sense to me, but it's just how it is, right? We pay on April 15th for the first quarter, pay on June 15th for the next 2 months, September 15th for the following 3 months, and the last 4 months get paid in January. Weird, but that's how they decided to do it. And so the way it works, really how your accountant is doing it when they're estimating what your quarterly taxes should be, usually they're just taking what you owed last year and dividing it by 4. Like that's it. It's not that fancy. It's not super crazy math. It's, hey, what'd you owe for taxes last year? Divide by 4. Boom, there's your quarterly estimated payment. Usually they aren't looking at what you're actually making this year. If your accountant is not lazy, they will take your profits from the last quarter and they'll do an actual estimate. Or if you've got our spreadsheets, I have a spreadsheet where we do our own quarterly estimated taxes because we like spreadsheets to tell us what to do. And it's just like, oh, you made this much, cool, save about 30% of it and pay that. But estimated taxes, they're fun. Okay, so let's talk about saving on taxes. This is what you're really here for, probably. Well, the IRS will let you deduct ordinary and necessary business expenses. So just a quick laundry list of a couple cool things that you might have heard on a YouTube video somewhere that you can write off. And I'm going to add a couple more to this, but stuff like, oh, a business cell phone, right? Or maybe I have a personal cell phone that I use 50-50 for business. I can deduct 50% of it. Depending on how aggressive your accountant is, will depend on what they tell you you can or can't do. I'll just tell you every accountant has a different level of risk tolerance for this stuff. And so you go to one accountant, they'll be like, oh yeah, you can write off your whole cell phone bill because it's ordinary and necessary for a business to have a cell phone. And another one will tell you, if you're using it 50%, you can only write off 50%. Have an accountant, follow whatever they say. And if you feel like, my accountant isn't very aggressive and they're not telling me proactively how to do all this stuff, maybe you need a new accountant. Or maybe you need to up your level of financial stewardship and get a real handle on this stuff so you can challenge your people appropriately. There's stuff like if you have a home office, obviously you can deduct a percentage of that. Computers, office supplies, business coaching, business books. There's specific rules around travel. There's certain healthcare insurance costs that you can write off. There's car mileage. A lot of people buy cars through the business themselves. This one is really commonly missed, which is interest from your business debt. And so look at your profit and loss statement and see, do they have a line on there that says interest paid for the year? And if they don't, shake them a little bit, shake your bookkeeper and say, hey, I've been paying all of this interest on these loans and on this credit card. I'd love to make sure I'm getting a write-off for it. The other one is that gets missed a lot is depreciation from assets. Lots of big words. If you were to buy a car or a vehicle in your business, or maybe a large piece of equipment, you want to make sure that it shows up on your balance sheet. Because if it doesn't, your accountant isn't going to know that you own that thing, and they're not going to be able to take a little slice of that and apply it as a business write-off. That's all depreciation is. Let's take a little slice of that expense and take that as a tax write-off each year. I have found so many business owners who don't have all of their assets listed on their balance sheet, so they're not getting any of the tax benefits from owning that piece of equipment or that car or that truck or that whatever. So make sure your balance sheet is right. Again, this is why the Better Books worksheet that we had last week was so important. Last thing here is a quick summary of how to look at your accountant. Number one, just make sure that you have a good accountant who will sit down with you and be proactive with this. And number two, know how to challenge them. I sit down with accountants all the time with our clients. I had 2 meetings this week with our clients where I was sitting down with their accountant because their accountant hadn't done stuff right. Accountants make mistakes. Bookkeepers make mistakes. You need to know how to appropriately challenge them. And so if your accountant is saying, yeah, you're at $100,000 of profit, I don't think you're ready yet for the S Corp. Ask them why. Challenge that. Hey, I would love to know why. Can you explain it to me? I'd love to hop on a call, right? Can you explain it to me? If your accountant says, gosh, you made so much money this year in profit and you're going to owe a ton in taxes, but you feel like, no, I didn't make profit, or I don't have any profit left over in my bank account. Where is it? Challenge your bookkeeper. I see people who have double counted the money in their account for years because they got money into the account, it got counted as sales, and then they transferred it from one account to another, and that got counted as sales again. We had someone who had double counted all of their revenue for almost 3 years straight and owed the government $30,000 of back taxes, but had actually lost money every year from a profitability standpoint. And because they didn't challenge their bookkeeper and their accountant, they just had to pay it. I made a mistake 3 years ago on my taxes, and I double counted my money because I didn't understand how it all worked as I set up our S Corp. We have a totally crazy next level S Corp structure. I double counted my revenue and I overpaid by $22,000. And when I tried to push my accountant on it and the bookkeeper on it, I didn't know enough to fully push all the way. I pushed and I pushed and I pushed like, this can't be right. This can't be right. This can't be right. No, it's right. Finally, I had to file an amended return. Learn how to push back. This year, I had to push back on my accountant with a deduction where he was saying, oh, you had 5,000 of income here. And I had to push back. And I had to push back through multiple emails. And then we finally got to the point where it was like, oh, now I see what you're doing. Okay, makes sense. Yeah, sorry. Someone else's accountant didn't give them one of the biggest business write-offs that they should have gotten. Just plain old didn't give it to them. And when we were looking through their taxes, like, yeah, you didn't get that. And it cost them $3,000 extra because they didn't know what to do. This stuff costs business owners a lot of money when they don't know enough to push back. So learn how to push back. So 3 quick things, the 1-minute version of how do I understand taxes in the business. 1, finance pants. If you own the business, you own the profit, whether it's sitting in the business account or it's sitting in your account. Number 2, you are taxed on that profit. And number 3, you should save probably about 30%. This is the one thing, the one sticky note from this that I hope you remember these things because it will save you so much heartache down the road. So top 10 tax mistakes in 1 minute. Number 1 is not saving enough for taxes every month from your business. Number 2 is trying to break even on your profit so that you don't pay taxes. Number 3, waiting until the end of the year to do your books. Just get a bookkeeper and have them do it along the way. Number 4, reporting your revenue instead of your profit as income to the IRS. I've had this happen when people have done their own books and done their own taxes. It's messy. And then they don't get any of the business write-offs. Number 5, not having an accountant to give you tax advice. Number 6, having a bad accountant. And I will say 6.5, not being able to push back on your account. Number 7, staying as an LLC once you've passed that $50,000 a year in profit. Number 8, not getting W-9 forms to your 1099 contractors. That's a big one. If you have 1099s, you got to get them their W-9 form. You've got to get a W-9 form from them so you can 1099 them. Number 9, not learning about the tax deductions you can take. Number 10, never learning how taxes work in the first place. We've just solved a lot of that over the last half hour. So if you want help making sure that your business finances are dialed in and that you actually understand what's going on in your business, this is what we do in CEO Finance Academy. We work with businesses who are doing over $250,000 a year up to about 15 million. And we do 3 major things. Number 1, we get a deeper understanding of their finances. We help them get that deeper understanding so that they can take control of the business. Number 2, we install better financial systems so that they don't have tax surprises, for example, so that they can stay profitable, so that they can see when things are going up or down. And number 3, we put in simple processes that they can repeat on a weekly basis, and then on a monthly basis, and then on a quarterly basis to be able to manage finances simply and easily so that they actually profit what they intended to and keep that profit to be able to grow personally, to be able to treat their employees right, and to be able to work with the customers they actually want to work with. So if this is you and you're like, wow, I want this. Will, could you drop a link to where people can go on our calendar? We can sit down for 15 minutes with our team and see where do you need to focus financially next in the business. We call it a profit clarity call. And we'll sit down and give you an exact, okay, I think you need to focus on this. If we are the right fit to help you do that, we can have a follow-up deeper dive call. We'll look into your numbers at a deep level and see, okay, what makes sense, and are we the ones to guide you? We're sitting down one-on-one with our clients to walk them through not only the tax stuff, but profitability and margins, cash management, cash flow management, debt payback, employee compensation, and my favorite, owner compensation. Because at the end of the day, if the business is not paying you, why are you working so hard for the business? Y'all, this has been the tax workshop. Any questions along this? I know I went 33 minutes. I held you over by 3 minutes. Do you have any questions about this? And if so, I'm happy to answer it for the next couple of minutes on anything that we talked through today. Hopefully this was useful. I would love to know, what was the one nugget that you got out of today? If you're still on here, will you just type in the chat? What is the one nugget that you got out of here today? It will cement that learning for you, and it'll be great feedback for us for what you actually found valuable on this stuff. Would you let me know in the chat, what was the one piece of like, ooh, this was good that you got out of this? Whether it's an insight.
While you guys think about that, if you would like to partake, we'd love it. We also have 2 other longer form workshops on taxes, one about reducing self-employment tax. So if you're self-employed, let us know. Self-employed meaning you are not on payroll, meaning you pay yourself directly from your LLC. We have a full workshop on that. Just let me know. You can put in the chat self-employment. I will make sure we get that over to you. And 2, we have a longer tax workshop. The title of it is escaping me right now, but I know we have that too. Alex, you've done a longer one. We can send that over as well if we need.
Yes, sir. No questions nugget. Don't be afraid to push back. Yeah, it's okay to do. And in fact, you're going to have to do it at some point. It's, I feel like a lot of times we don't feel empowered as business owners to push back. It's like, I don't know if I can, and I'm paying them. And it's like, yeah, but at the end of the day, you own the financial outcomes in the business, not them, right? They don't have to deal with the repercussions of them making little errors here or there. And if you don't understand something, it's okay to push back and ask. Totally fine. All right, cool. So Will, we got a couple people interested in self-employment. That'd be awesome. Sweet. All right, y'all. This has been another Friday Lunch and Learn. We're going to do another. We've got like at least 5 more of these lined up with topics ranging from covering how to pay your people and how to make sure you do it profitably, to how to avoid what we call the profit valley, where you're scaling but making less than you ever have before. We've got a whole slew of these lined up, and we've done a bunch of them over the past month. If you want more of this stuff, go hit us up at ceofinanceacademy.com. Or if you're watching the replay, you can hit all the links that we'll put below to book with us on our calendar or check out our other workshops. And they have differing advice. How do you know who's right? Right? Isn't that the fun one? Because they do. People have different advice. And it's like, I don't know who to trust. And that's why it's on us as owners to get as educated as we can to be able to make sure that, cool, what I'm doing makes sense for me. And do we have to be tax experts ourselves? No, but we've got to understand, like, generally, how does it work? And then I got to go with someone that I feel like understands taxes at a deeper level than I do, and will actually sit down to help me do it. Cool. All right. Thank you all for being here. Come on over next week, and we'll see you again on the next one. Bye, y'all.